Typically, when an investor wants to make money in the stock market, they will invest in stocks that they think will bring greater profit in the future. However, there is also an opportunity to bet on a company failing. In this case, if I think that a company's stock value will drop in the future, then I might try to borrow a stock from someone else today and sell that stock while it has a high price. Then tomorrow, once the price of the stock decreases, I can rebuy this stock for a cheaper price and return it back to its original owner. The difference in the two prices, the price at which I sold and the price at which I rebought it, is the profit that I make when I am shorting the stock. Hedge funds act in a slightly different way than regular investors. A hedge fund manager actually looks for sometimes weird or unconventional opportunities to invest the money of the people that participate in this hedge fund. A lot of hedge funds are interested in shorting stocks as a means of making profit relatively quickly. The name of the hedge fund comes from hedging risk. If there are just a few individual investors, then they have to pick some type of very risky investment, and they stand to lose their money or gain a lot of money. However, if those individual investors get all together in this so-called hedge fund, then they get to hedge against the risk, because they will buy a mixed portfolio of different financial instruments, which will ensure that they will make some sort of acceptable return in the future. Shorting stocks is one of the things that hedge funds usually do with relative success. Investors on Reddit thought that by some specific date at the start of this year, the hedge funds that had shorted GameStop stock would be contractually obligated to buy it back. So the thinking behind those traders was to buy as much GameStop as possible before this date, therefore causing a short squeeze. Now this date arrived, and the price of GameStop skyrocketed from about $80 to more than $300. It even reached $500, if I remember correctly. The problem is that the short squeeze never really happened. The hedge funds weren't actually obligated to trade on that date, or they had an ability and an opportunity to push this date further back. Therefore, the next week, the price of GameStop crashed because investors lost interest, and they also lost trust that this short squeeze would actually happen. GameStop is still trading at a much higher price than what it originally did, but it's nowhere near close to the astronomical returns that the investors on Reddit thought that they would get. During those days where the GameStop trading frenzy was happening, there were a lot of calls about regulating or taking a look into the short market. There were policymakers talking about it. AOC was discussing it. Politicians in favor or against Wall Street were going on TV giving their own opinions. However, I personally believe that we're not going to see a significant change in regulation. Even though people were discussing about millions or even billions of dollars being lost or gained by the Reddit traders or the hedge fund managers, in reality, this was just an interesting event that passed. It made a lot of headlines, but didn't really affect the markets in a way that regulators will really spend time looking at. The current administration has just started work, and they've got, in my opinion, way more interesting and more pressing matters to attend to than take a look into stock regulation.
Jordan Bell Spurred. Jordan Bell Spurred. Yo, 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 yo. I've been getting dirty money, Jordan Bell third. Stacking penny stocks while I'm flipping these birds. Sipping on Ciroc, trip 'em up with the words. I done popped them and I think it's be my third.